Good afternoon, everyone. I'm Pamela Hastings, Relationship Manager at Barometer Capital. Thank you so much for joining us for another Wednesday afternoon webcast. Joining me today is David Burrows, Chief Investment Strategist and President at Barometer Capital. And during this call, we will provide you with a brief market overview and address your questions at the end of the call. If you have questions, you can email me at phastings@barometercapital.ca, or you can hit me up on the chat or Messenger on this Zoom link. So thanks so much for joining us. And with that, I turn the conversation over to David Burrows on a very historic day. Good afternoon, David.
Hi, Pamela. How are you? Thanks so much for doing this today.
Of course.
Thanks everybody for tuning in. It is an interesting day. I have to say, watching the inauguration this morning, I did have a little bit of a sort of visceral reaction, thinking about the possibility of not waking up each morning wondering what was coming over Twitter. We know that investors do not like uncertainty. And in some ways, things feel a little bit less uncertain today. So certainly good to hear a message of unity and one of perhaps some healing in the U.S. And the markets are certainly responding, well accordingly. I thought what I'd do today is just kind of quickly run over thoughts on where we are in the market. Market seems to be progressing in a fairly orderly way. Here we are in a new year, and as would be typical, the themes that sort of ended the year seem to be carrying on. And so as we do, I'm going to kind of look through our lens, and our lens is, first of all and foremost, trying to understand the macro environment that we're in, to try and identify the key themes, the structural changes that are taking place, which asset classes and geographic regions and sectors and themes have a tailwind, and try and focus our attention in those areas. We don't definitely want to be everywhere. Always there are parts of the market that have become overowned and overpriced, which perhaps have the tide going out. We're always looking for neighborhoods that we can invest in that are seeing new tailwinds, where there could be a long runway, and focus in those areas of leadership. We're watching for change always. And we've spent some time talking about that over the last little while. And then there's those periods where nothing's working and you have to have an ability to be on the sidelines. And certainly we're willing to do that. That's not as it is right now. There is quite clear leadership, and there are some pretty good tailwinds. So we'll talk a little bit about that. But really what we're trying to be is tactical and pick our spots. And it's interesting because you go through periods of transition sometimes where the leadership is not clear, or you're going through a period where the baton is being handed off. And sometimes it is that you get ready for what is coming next a little bit early. Sometimes things get derailed like they did in the early part of last year as transition was happening. But in the end, when the market is set to make a change, it will invariably happen. Sometimes it takes longer than other times. So most people know that we think that we have been in a structural bull market in US stocks since 2013 with interruptions after a long period of wandering through the woods between 2000 and 2013. Certainly there were places to make money in cyclical rallies, but the market didn't make much long-term progress. And we're a lot like sort of where we were, I believe, in the late 1980s, where there's still a long runway in front of us. This bull market kicked off in 1981. 7 years in, it was 1988, and there was a long way to go. Certainly, similarly, when the market kicked off a rally in 1951, 7 years in, it's 1958. Market rallied to 1966, of course, with interruptions. So we've had a tailwind in U.S. stocks for a long time. We've talked about the fact recently we've seen some real acceleration in global stocks that in fact have been out of favor for as long as 10 years, and in case of Japan, 30 years. So that's interesting. It's a broadening of interest in the equity asset class. And that we continue to kind of be in a channel in the S&P and in the NASDAQ. In rates, we've talked about going through a troughing in rates like we did in the late 1940s, and that seems to be playing out as well. And we've been talking about, at the same time, a third asset class commodities, which have been in a very long bear market, are very underloved and underowned, and they appear to be making a change. We talked about how the whole group is breaking from a 10-year bear market, that the metals and mining companies are certainly doing that. And interestingly, after a long period of broad outperformance of equities versus commodities, that appears to be changing. We're seeing an acceleration in commodity prices, and certainly companies that produce commodities. And again, when this happens, it tends to go on for a long time. Now, we know there's been tons of stimulus pushed into the system by the Fed, by the European Central Bank, by the various Asian central banks. And as we've talked about, as we get through this vaccine phase in the virus, this fiscal and monetary stimulus is going to find its way into the real economy globally in a synchronized way. And I think will create quite significant demand. And we're seeing that play out in more cyclical assets, things where prices go higher when demand picks up because the last dollar of demand sort of sets the price for the world. We know that there's been a ton of currency printed around the world. And as a result, investors have chosen to take paper currency and make investments in real assets and productive assets. So US dollar has been being sold. And, there will be fits and starts. This is really only the last year. And over the last couple of weeks, US dollar had a little bounce, much like it did in October into the beginning of November when it rolled over and the market really took off, or much like it did in June, July. But we are clearly in a downward trajectory in US dollar until this trend breaks. And my guess is we are probably half to 2/3 of the way through this dollar decline. It's likely to continue on. So certain things tend to be bought when people get rid of US dollars. US dollar, as I talk about, can go lower, probably targets initially on the dollar index of about 86 versus the basket of world currencies, another 7 or 8%. A big beneficiary has been emerging markets. And emerging markets have been in a bear market for a long time. And we really sort of broke out back in November, December, and they have been outperforming ever since. If you take a look at the emerging markets index and then look at the relative performance versus the MSCI World Index, emerging markets are clearly outperforming global stocks. And this is a group that is underowned. I can remember times in my career where all people wanted was emerging markets. And I have had very few conversations over the last 2 or 3 years where clients said, shouldn't we have more emerging markets? China's been in a bear market for 5-6 years and other emerging markets much longer. But that does appear to be resolving. And that is a significant opportunity because just like when US stocks came out of their bear market in 2013, here we are 7 years later, almost 8 years later, and stocks have been pretty consistent. So the Chinese consumer is doing particularly well. Now, it makes some sense. China has come out of this COVID situation, from what we know, much earlier than the rest of the world. They are seeing very strong consumer demand. There is a strong consumer class building in China. And this is probably one of the most productive areas of the market globally that we could be focused in. And certainly we have exposure there in our global strategy. But India, this is the turn in November, really has taken off and is very consistent. Other major Asian countries strong, like Korea and Taiwan. We've been talking about that. And they are not showing any signs of letting up. The S&P, when it broke out in November, has had fairly consistent move forward with little tiny pullbacks along the way. Today, accelerating again. Not all parts of the S&P are participating. It is a quite broad-based rally, and many sectors are, and some sectors that have not for several years. Mid-cap stocks, in particular, are performing well in the US, much stronger than large cap stocks. We've seen lots of small and mid-sized companies really go to town in the market. And that's evidenced by what's happening in the market for SPACs, or special purpose vehicles, where it's an effect a way for a company to go public in a less expensive way. And certainly we've been participating in SPACs, and we may make that a topic of one of our future calls, but very, very strong performance in some of these mid-cap stocks. Now, we've talked about reflation and the reflation of assets and what that means for investors. We've seen a disinflationary world for a long time. And so things that do well in falling interest rates up until this year have performed particularly strongly, like utilities and phone companies and real estate investment trusts, because the yields were attractive and they were relatively low economic sensitivity. And with all this stimulus and both monetary and fiscal and the weaker dollar, the likelihood of inflation is picking up. The central banks are making it clear they don't no intention of raising rates anytime soon, even if inflation were to run hot. And so expectations for higher inflation are coming in the market. So we want to own things that have an ability to raise price when demand goes up. So for instance, probably the best example of that is the semiconductor industry, because there's a very quick inventory cycle. Nobody wants to inventory very expensive semiconductor chips when they're not being used. So there's a very quick order cycle. When demand picks up, orders pick up very, very quickly. And when they pick up everywhere in the world at the same time, prices go higher. So companies like Micron Technologies that make more commodity type chips, the memory chips, see their pricing really firm up. And certainly when demand picks up, the demand for equipment, manufacturing equipment picks up. And this has been an area that we've been invested in. Companies like Applied Materials, which makes equipment to produce semiconductors. Lam Research, which makes equipment to produce semiconductors. We've talked about Taiwan Semi over the last few weeks. Taiwan Semi this week reported that as opposed to the expectation that they would spend $17 billion on capital expenditures this year, they're saying it's more likely to be something like 28 billion or 50% higher than the street was expecting. And obviously that has an impact on the companies that sell manufacturing equipment. And when the demand is high, their ability to charge the right price gets stronger. So semiconductors have been the most cyclical part of technology, and that has been our focus since November. And this group obviously is having quite a move. We've talked about resources, commodity producers, and the fact that the last marginal dollar of demand sets the price for everyone. Freeport-McMoRan is one of the biggest copper producers in the world. They also produce gold. And the reality is that at a time when we're about to see a significant pickup in demand, global copper inventories are as low as they've been in years. And the number of new mines coming on is like zero. There haven't been new mines built in several years. So less supply, more demand, higher prices. This is a reflationary asset. We own companies like Teck Resources, Hudbay Mining, First Quantum in Canada. And this is a group that is one of those assets that does well in a reflationary environment. And these producers have been out of favor for years. Equipment producers. We talked last week about the agricultural sector performing much better. Prices for food are going higher. Farmers are going to have more money to spend. Deere in particular is a big beneficiary here. But in the mining side, Caterpillar is a beneficiary. And Ingersoll Rand in the construction industry. And if there's fiscal stimulus for building new infrastructure, likely all of these companies benefit. Even heavy equipment companies and industrial companies like General Electric are having a real resurgence. More value-oriented, clearly we're out of favor for a long time, but companies that benefit from a stronger economic cycle. We've talked about the banks being stronger, and we've had some pretty good reports from the banks over the last week. We have some concerns with the fact that some of the improvement in earnings have been just them taking reserves back off their balance sheet for bad debts. But the more market-related companies, where they're making revenue from trading and making revenue from corporate finance, have been beneficiaries. Certainly Goldman Sachs had pretty good numbers. Morgan Stanley's been performing well. Also in financials, still the financial technology companies continue to do well because structurally there's a major change taking place in the way that we manage payments. Lightspeed is one of those companies in Toronto that is a major beneficiary from point of sale. One of the sectors we haven't spent much time talking about is auto, but we do have quite a number of investments here. We know that demand for automobiles in the US is resurging. In China, it's very strong. And it's happening at a time when the industry is going through a major transition. We all talk about Tesla, but Tesla was the leader in moving towards electrification. The whole industry is going there. General Motors has a legitimate shot of building some market share here in their Cruise division, which they are a significant investor in. Cruise is the brand that will be the electric brand. Also with self-driving, Microsoft has invested this week, and they have other partners also participating. But this is a major transition for this industry, and there's going to be big winners and losers. In particular, in the heavy equipment, Ballard is making waves, and in the assemblers and sub-assemblers, Magna is a global leader that's benefiting in China and benefiting in the U.S. and is a potential partner for Apple if they were to make a move into electric cars, which they have said that they're strongly considering. So we do have exposure through this group, companies like Linamar, companies like Martin Rea in Canada. Again, all of these groups since November really caught a bid. And you have to prepare and be positioned for when that takes place. And I think people have been quite surprised at what's happened to portfolios just in the last 3 months in the early stages of this reflationary move. Now, since November, we have seen the NASDAQ, which led all the way off the lows until summer, really consolidate and somewhat underperform relative to the S&P. We went through several years where the largest companies in the NASDAQ were really the only companies that people wanted to own. Now, as portfolio managers, we can't focus all of our money in those 6 or 7 very large stocks. And certainly we have been preparing for a more reflationary cycle. But a couple things can happen. When a group corrects, like those big stocks have since summer, they can either eventually roll over, being a source of cash to invest in other sectors, or at some point, they start to participate too. So today, I think, was a pretty big day because some of the companies that have been underperforming really started to take off, led by Netflix with very strong results, up 17% today. Alphabet, up at the time when I came to set up this call, up about 6% on the day. Apple having a strong move, up 3.5%, and Amazon up about 5% on the day. So it's good to see these companies reaccelerate. We want to see the market continue to broaden. We want to see broad participation, but certainly big cap tech seems to be rejoining this rally. Now, one group that's been correcting recently within the resources have been the gold producers. After making a turn through 2016, 17, 18, rallied until the fall, and we pulled back, certainly, which is perfectly typical. The gold producers are relatively inexpensive on a cash flow basis. But again, today, we're seeing these groups turn back higher, both gold and silver producers having a very, very strong day. So we're in a pretty broad rally. Lots of things doing well. From a yield perspective in the income portfolios, we continue to focus on dividend growth. Because if we think that long-term rates can slowly go higher, we're going to need to see a rising stream of income from our investments. And so since November, in keeping with this reflationary theme, dividend growth stocks are way outperforming high dividend paying stocks. These are the things that did well through the 50s and 60s as rates started to go higher in the last cycle. But again, this is very early cycle. Keep in mind that people have piled money into treasury bonds for a very long time during falling rates, and we're only just now starting to see flows come out of treasury bonds and looking for alternate sources of income. So look, when we look at the health of the market, what we care about is we want to find areas within the market that have become underowned and where we start to see improving breadth. In other words, more and more companies participating in that theme, or more neighborhoods within that theme participating, and that's what we're seeing. Things like global stocks, emerging markets, commodities, industrials, financials, consumer discretionary companies. These are all companies that benefit in this reflationary theme, and we're seeing clear expanding breadth. We will watch every day for deterioration or to see some of these start to weaken, but I think we're very early in that phase of acceleration. Too early to see this. 2 weeks ago, when we looked at our indicators, our long-term indicators for Canada, the US, and globally, were all positive. The percent of stocks participating in the rally has been expanding. Our short-term indicators were somewhat sloppy after consolidating through the holiday season. And as we sit today, virtually all of our short-term indicators are improving. Our long-term indicators are improving. It's a healthy market. And just to put a point on that, to look at it another way, if we put the stock market on the top of this chart, and on the bottom we measure the percent of stocks within the market that are in long-term uptrends, or the bullish percent. When we see rollovers in the market, most often the bullish percent has been falling, meaning the percent of stocks participating in the rally has been deteriorating or narrowing. Again, here in 2008, we narrowed for several months before the market got into difficulty. In 2011, several months before the market started to weaken. In 2015, the same. As we sit today, breadth has been expanding steadily. So I can say that since 1950, there has been no significant correction that happened before some deterioration in breadth. And so we will watch, but at this point, really no sign of it. From a COVID perspective, some of the COVID numbers are becoming a little bit more encouraging. The vaccine certainly is starting to get out there at various rates in different parts of the world, but the percent positive on a 7-day average is starting to fall in the US. That will be encouraging for the market. And certainly if we had some political stability, that will be seen as less uncertainty. The most important thing we're going to watch in the next few weeks are earnings. We are into earnings season post the fourth calendar quarter. We know that the share buybacks have stopped. Companies tend to stop their share buybacks during their earnings period. And then we get some real news on earnings. So interestingly, around the world, the expectations for earnings has been rising since the summer of this past year. If you take the S&P in particular, we had a low for estimates in May. They've been improving since. They pulled back a little bit in the beginning of December, but then again started to firm. This is unusual because historically in the fourth quarter, as you go through the fourth quarter, analysts realize it is unlikely that companies will wind up with numbers as strong as they thought earlier in the year. This year is quite different. The estimates have been very, very strong. So we expect to have a pretty strong earnings period. We'll certainly report on it as we go through it, but it looks to us like we are likely to have better earnings reported than are generally expected. And the market seems to agree with that. From a sector exposure standpoint, not much is changing. Some very small adjustments from 1 month ago. In general, though, we continue to be very focused on these reflationary assets. And things are going well. We've had a great start to the year. Our various pools and funds are up strongly to start the year, certainly versus the indices. The last 6 months, as we came through this reflationary period, portfolios are really accelerating. So we look forward to that continuing. It's something that we watch closely. And if things start to weaken, we'll get defensive. From a currency perspective, just to wrap up, Canadian dollar continues to firm up. which means that we have focused in separately managed accounts more inside of Canada and some global securities. And in our pools, we are hedging our currency back to Canadian dollars because we don't want to lose money on the currency while we make money on the securities. So Canadian dollar we're using as our base currency. Now we'll look for signs of any kind of weakness. We aren't seeing it at this point. Seasonally, we are in a strong period of the year. We'll watch for any signs of deterioration in breadth, and if that were to take place, we'll get more defensive. But we think that there's opportunity in front of us. And at the beginning of an economic cycle, and the market is sniffing out the beginning of a stronger economic cycle post-COVID, these groups should participate well for the next 2 to 3 years. So with that, I can pass it back to Pam, and thank you very much for tuning in. If you've got questions, certainly we'll try and answer them.
Thanks so much, David. We have one question here. David, are you rotating out of the same areas that produced such wonderful Q4 results? And if so, is this a means of locking in some of our gains? That comes from one of our very keen investors.
Yeah, I look at, because the calendar changes doesn't mean the market changes. And if anything, it causes investors who have been left behind to get a little fire lit under them to figure out what they need to do differently. Our positioning in these reflationary assets that has taken place really over the course of a year was to get ready for a cycle that is likely to be years long. So no, we're way too early to be locking in gains, and certainly we're going to see corrections. We're going to see rotations short-term in nature. But we really think that we are in the early stages of a long-term cycle. Now, I mean, if I look back at our history, the 1990s was a 10-year period where growth stocks way outperformed. And I can't tell you how many times people asked us, shouldn't you be taking money to the sidelines? But it went on for 10 years. And then when income securities started to outperform in 2001, of course, nobody wanted income securities, but the income trust looked really interesting to us. That gave us a 10-year runway. And the whole way along, they looked expensive relative to what they had looked like a year before. When energy started to run in 2009 because of fracking, it was 5 years where oil went from $20 to $160 a barrel. So I think that our strength is finding new themes early, getting positioned, and then staying with them. And that's why we use stop losses. Stop losses not only protect you when things roll over, but they let you stay in positions as they continue to work. You don't have to pick a top. So I would say that for the majority of the themes that we own are significantly, severely underowned by the market. And I think that it will take a long time for the majority of investors to build up positions in things like these commodity producers, the heavy equipment companies, the automobile companies. Certainly there's areas that are a little more crowded. Alternative energy has become a little bit more crowded, solar, for instance. Maybe electric vehicles. Certainly there's a lot of expectation being built in, but it's going to be a giant shift in the way that the market operates. So we'll watch for any signs of deterioration, but at this point, I think that we have a fair bit of running room in front of us.
Thanks so much, Dave. With that, one other question here. What currencies do you think will strengthen the most as the US dollar falls?
Right. Well, clearly when we looked at, and we talked about this a couple of weeks ago on one of these calls, the US dollar as a percent of foreign reserves globally is falling. There's no question. Also, the percent of reserves of bonds being held by foreigners, US dollar bonds, US Treasury bonds are falling as a percentage. I think you would see in the numbers that Chinese sovereign debt is being more broadly held. The Chinese currency is strong. They have a very strong consumer class. And so the Chinese currency is likely to be strong. The euro is somewhat stronger. And I think that that's something that you can expect to continue to see in the near term. Most currencies versus US dollar are stronger, Canadian dollar and Australian dollar, because of course we are tightly correlated to resource prices. And we think that, as we showed in the beginning of the deck today, we're in the beginning of what is likely to be quite a long commodity cycle. So I think that it's a basket. I think Asian currencies in general look attractive. I think that the resource currencies look attractive, and certainly the assets in those countries look attractive. Canadian market may be set to outperform U.S. stock market in the near term as energy and resources firm.
Thanks so much, Dave. One more question here. How do you see the demand for electricity production and revenues play out as more and more electrical vehicles are produced? I'll give you an example. I was in the Audi dealership, and they said this will probably be the last gas guzzling vehicle you will ever purchase. Everything is moving electric. You, of course, have been a fan of that, and I would imagine that plays well for lithium as well, but maybe you could comment on that.
Sure. Look, there is going to be rising demand for electricity. I think if you look at alternative sources of power, like we own a number of alternative energy companies. Probably the biggest one that we own is Nextera Energy. NEE, that trades in New York. Let's see if I can put it up on the screen. Can you see that, Pam?
Yeah, I can. It's a great company. It owns FPL, Florida, one of the utilities we use down here.
So this is the fastest growing utility really in the world. They have the highest percentage of alternative energy, wind and solar. And now that solar and wind are competitive, if not more competitive than, say, a coal-fired plant, they're in a really strong position to continue to grow. So it's a utility, but it's a much higher growth utility, and this is why we own it. I think that the demand is going higher, and I think that it's something that we have to be watching. And alternative energy is not going away. This is the ETF that is solar energy, and we own this in our global portfolio. And clearly, you know, the Biden administration, if I were to take let's say a 1 year picture, you know, off the lows, this ETF was at $20 at the lows in March. It's $115 today, so it's up 500% over the course of the year. You know, there is very real expectation that there will be continued incentives to move away from carbon-based energy. And it's not to say that there's nothing to do in carbon-based energy, but, you know, it's a far different picture to look at the oil producers and gas producers than it is the wind and solar companies.
Thanks so much, Dave. Well, I believe that concludes our questions for today. So appreciate everyone joining us on this momentous day. And with that, David, I guess we'll see everyone next Wednesday afternoon at 4 p.m.
Yeah, certainly don't. If you've got questions in between, don't hesitate to call us. We're trying to reach out to all of our clients right now to set up conversations to try to frame out the year. And if you've got topics that you'd like us to cover in these calls, please send them in or call us and ask the question directly. So thanks very much, everyone, for tuning in. Pam, thanks for moderating, and we look forward to seeing everybody again next week.
Thanks, everyone. Have a good afternoon.